Hello, everyone. My name is Dr. Kai Soto, and I will be your digital avatar professor for Introduction to Corporate Finance here at MetaU. Corporate finance is a critical aspect of modern business that deals with the management of financial resources to maximize a firm's value. It encompasses a broad range of activities, including capital investment decisions, financing choices, and dividend policy. The central objective is to make decisions that enhance the company's value for its shareholders. This discipline melds concepts from economics, accounting, and management, requiring a nuanced understanding of both the market and the internal workings of the company. The role of the financial manager. In the realm of corporate finance, the financial manager plays a multifaceted role. One of the pivotal roles is that of a salesman. This aspect of the job is often overlooked, but is critical to the success of any corporation. The financial manager as a salesman, promoting financial health. The financial manager acts as a salesman by promoting the financial health and stability of the company to external stakeholders. This includes investors, creditors, and even customers who have a vested interest in the company's financial strength. Attracting investments. The financial manager must be adept at presenting the company's financial position in an appealing light to attract investments. This involves a deep understanding of what investors look for and the ability to communicate the company's potential for growth and profitability convincingly. Building investor confidence. Continuous engagement with investors is crucial. This includes regular updates on the company's performance, future prospects, and strategic decisions that might impact financial outcomes. The goal is to build and maintain investor confidence, which is vital for the company's stock price and overall valuation. Negotiating with creditors. The financial manager also acts as a negotiator with banks and other creditors. This involves not just securing loans or lines of credit, but also negotiating terms that are favorable to the company. It's a delicate balance between ensuring liquidity and maintaining a healthy debt level. Public relations. An often under-acknowledged part of the financial manager's role is public relations. This involves communicating financial information to the public and the media. The way financial data and company news are presented can significantly affect public perception and, consequently, the company's market value. The art of persuasion. The financial manager's role as a salesman requires a combination of analytical skills. And the art of persuasion, understanding complex financial data and market trends, is fundamental. But so is the ability to communicate this information compellingly. The financial manager must translate technical financial concepts into clear, persuasive narratives that can be understood by a non-specialist audience. Conclusion. In summary, the role of the financial manager as a salesman is multifaceted and requires a blend of technical knowledge, strategic thinking, and communication skills. By effectively managing the perception of the company's financial health and prospects, the financial manager plays a crucial role in enhancing the company's value and securing its financial stability. The core function of a financial manager in a corporate setting is not only to manage the company's finances, but also to act as a key player in the sphere, issuance and management of various financial securities. This role is pivotal in securing capital for the company's operations and growth. Financial securities. An overview. Financial securities are instruments that hold monetary value and can be traded in financial markets. These include stocks, bonds, and derivatives. Each type of security represents a different method of financing and carries distinct risk and return profiles. Stocks. Equity financing. Issuing stocks is a form of equity financing. Here, the company sells shares representing ownership stakes to investors. Capital raising. Selling stocks is a way for companies to raise capital without incurring debt. Risk and return. Stocks are riskier for investors compared to bonds, as their return depends on the company's performance. However, they also offer the potential for higher returns through capital gains and dividends. Shareholder rights, where shareholders gain voting rights and a claim to the company's profits. Bonds. Debt financing. Bonds are a form of debt financing. Companies issue bonds to borrow funds from investors, who in return receive fixed interest payments. Fixed income. Bondholders are entitled to regular interest payments, coupon payments, and the return of principal at maturity. Credit risks. Risk associated with bonds depends on the issuer's creditworthiness. Higher rated bonds are safer, but yield lower returns, while lower rated bonds are riskier, but offer higher returns. Derivatives. Risk management instruments. Derivatives are complex financial instruments used for hedging risk or speculative purposes. Underlying assets. The value of a derivative is based on an underlying asset, like stocks, bonds, commodities, currencies, or interest rates. Types. Common derivatives include options, futures, forwards, and swaps. The role of the financial manager in issuing securities. The financial manager plays a crucial role in deciding which type of security to issue, based on the company's capital needs, market conditions, and the cost of capital. Capital structure decision. Choosing between equity and debt financing, or a combination of both, is a critical decision. It involves evaluating the cost of capital, the company's current leverage, and market conditions. Pricing of securities. The financial manager must determine the appropriate price. For new securities, this requires a deep understanding of market dynamics and investor expectations. Regulatory compliance. Issuing securities involves adhering to regulatory requirements. The financial manager ensures compliance with securities laws and regulations. Investor relations. Communicating with current and potential investors is vital. The financial manager must articulate the company's value proposition and growth potential to attract investment. Timing of issuance. Deciding when to issue securities is as crucial as deciding what to issue. This decision is influenced by market conditions, investor appetite, and the company's financial cycle. Marketing financial securities. The financial manager, in the role of a salesman, must effectively market the company's securities to potential investors. This involves investor presentations, crafting compelling presentations that highlight the company's strengths, future prospects, and financial stability. Roadshows. Participating in roadshows to meet potential investors, share information, and build confidence in the company's securities. Working with underwriters, collaborating with investment banks and underwriters to ensure the successful issuance of securities. Media and public relations, utilizing media and public platforms to enhance the company's public image, thereby making its securities more attractive to investors. Conclusion. The financial manager's role in the sale of financial securities is integral to the financial health and growth of the company. By effectively managing this aspect of corporate finance, the financial manager ensures that the company has access to the capital it needs to operate and expand, while also maintaining a balance between equity and debt and managing the expectations and confidence of investors in the market. The valuation of a company by financial markets is an ongoing process reflecting a multitude of factors ranging from macroeconomic conditions to company-specific news. The role of the financial manager is pivotal in understanding and influencing this valuation. Understanding market valuation. Market valuation refers to the price at which a company's securities, particularly stocks and bonds, are traded in the market. This value is influenced by both external factors and internal company performance. External factors influencing valuation. Macroeconomic conditions. Economic indicators like GDP growth rates, inflation, interest rates, and employment levels impact investor sentiment and market valuation. Market dynamics. Stock market trends, investor sentiment, and market liquidity play significant roles in valuation. Political and regulatory changes. Government policies, international trade agreements, and regulatory changes can affect industry prospects and, consequently, company valuations. Technological advances. Innovations and technological shifts can alter industry landscapes, impacting the valuation of companies within those industries. Internal factors influencing valuation. Financial performance. Key metrics like revenue, profit margins, earnings per share, and cash flow are critical in assessing a company's financial health. Growth prospects. A company's potential for future growth, as evident in its business model, market share, and expansion plans, significantly influences its valuation. Management and governance. The quality of management and corporate governance standards can impact investor confidence and valuation. Risk profile. The company's risk factors, including operational, financial, and market risks, affect its perceived value. The role of financial statements in valuation. Financial statements are crucial tools for investors to assess the company's value. The balance sheet, income statement, and cash flow statement provide a comprehensive view of the company's financial health. Balance sheet analysis. This involves examining assets, liabilities, and equity to understand the company's financial position at a point in time. Income statement analysis. This includes assessing revenue, expenses, profits, and trends over time to evaluate the company's operational efficiency. Cash flow statement analysis. Analyzing cash flow from operations, investing, and financing activities helps investors understand how the company generates and uses cash. Stock valuation techniques. Various models are used to value stocks, each with its approach and assumptions. Discounted cash flow EFL analysis. This method involves projecting the company's future cash flows and discounting them back to their present value using a discount rate, typically the weighted average cost of capital WACC. Price to earnings CREA ratio. This common valuation metric compares the company's current stock price to its earnings per share. Dividend discount model. Used for companies that pay regular dividends. This model discounts predicted future dividends to present value. Comparative valuation. This involves comparing the company's valuation, like teeth, ratios with those of similar companies in the industry. Bond valuation techniques. Bond valuation is generally more straightforward than stock valuation, focusing on future cash flows and risk assessment. Present value of future cash flows. The value of a bond is the present value of its future interest payments, coupons, and the repayment of principal face value at maturity. Yield to maturity. ETM is the internal rate of return on a bond, assuming it is held to maturity and all coupons are reinvested at the same rate. Credit risk assessment. The issuer's creditworthiness, as indicated by credit ratings, influences the bond's interest rate and value. Financial manager's role in market valuation. Financial reporting and disclosure. Accurate and timely financial reporting helps the market in valuing the company effectively. Investor relations. Proactively managing relationships with investors and analysts can influence perceptions and valuation. Strategic communications. Announcements regarding company strategies, mergers and acquisitions, and major contracts can significantly impact market valuation. Monitoring and responding to market valuation. The financial manager must continuously monitor market valuation and respond appropriately. Market feedback. The market's valuation provides feedback on how investors perceive the company's performance and prospects. Strategic adjustments. In response to market valuation, the company may need to adjust its strategies, operations, or financial structure. This is the identification, analysis, and mitigation of various types of risks that a company faces in its operations. Types of financial risks. This is the risk of losses due to changes in market prices, such as stock prices, interest rates, and foreign exchange rates. Tools for managing market risk include diversification, hedging with derivatives, and asset allocation strategies. Credit risk. The risk that a counterparty will default on its financial obligations. Credit risk management involves credit analysis, setting credit limits, and using credit derivatives for mitigation. The risk that a company will be unable to meet its short-term financial obligations when they come due. Liquidity management includes maintaining cash reserves and managing assets and liabilities. Operational risks. The risk of loss resulting from inadequate or failed internal processes. People and systems. Managing operational risk involves internal controls, audit processes, and business continuity planning. Our risk identification and measurement. continuously scanning the internal and external environment to identify potential risks. Quantifying risks, using statistical methods and financial modeling to measure the potential impact of identified risks. Value at risk here and stress testing are commonly used methods. Measures the potential loss in value of a portfolio over a defined period. Stress testings involves testing the resilience of the company's financial model against extreme market scenarios. Risk mitigation techniques for diversification. Spreading investments across various asset classes or sectors to reduce exposure to any one type of risk. Hedging financial instruments like futures, options, and swaps to offset potential losses. For example, currency risk can be hedged using foreign exchange derivatives. Transferring risk to a third party by purchasing insurance policies. Limit settings. Establishing limits on exposure to various risks, such as credit limits for customers. Integrated risk management. Holistic approach. Viewing risk management in an integrated manner. Considering how different risks may correlate and impact each other. Defining the level of risk the company is willing to accept in pursuit of its strategic objectives. Risk-adjusted return. On capital's rock for risk management, that involves calculating the return on an investment or project adjusted for the risk taken. Risk reporting and governance. Risk reporting. Regularly reporting risk exposures and the effectiveness of risk mitigation strategies to senior management and the board. Ensuring strong governance structures are in place to oversee the risk management process, including the roles of the board of directors and risk management committees. The role of technology in risk management. Utilizing advanced software for risk analysis, monitoring, and reporting. Leveraging big data and analytics for predictive risk modeling and decision-making. Automated systems for real-time risk monitoring and management. Compliance and regulatory aspects. Compliance. Ensuring compliance with relevant financial regulations and standards, such as Basel II for banking institutions. Developing and enforcing internal policies and procedures for risk management in line with regulatory requirements. In corporate finance, understanding and classifying cash flows is fundamental to analyzing a company's financial health. Cash flows are classified into three main categories: operating, investing, and financing activities. Each category provides insights into different aspects of the company's financial operations. Operating activities. Operating activities are the primary revenue-generating activities of a company. They include transactions and other events that are not investing or financing activities. Also plays a crucial role as a reality checker. This involves ensuring that the company's financial strategies and decisions are grounded in realistic assessments of the market, the company's capabilities, and the economic environment. The role of reality checking. Reality checking in corporate finance is about maintaining a balance between ambitious financial goals and practical constraints. It encompasses various aspects. Assessing market realities. Understanding the true state of the market, including demand, competition, and regulatory changes, and aligning financial strategies accordingly. Evaluating the company's internal resources, including financial, human, and operational capabilities, to ensure that financial plans are feasible. Identifying and realistically appraising potential risks in financial decisions, such as investment risks, credit risks, and market risks. Scrutinizing financial forecasts and projections to ensure they are based on realistic assumptions and sound data. Financial forecasting and reality checks. Accurate financial forecasting is essential for effective financial planning. The financial manager must ensure that these forecasts are realistic. Revenue projections, analyzing market trends, customer demand, and competitive dynamics to make grounded revenue forecasts. Assessing future expenses, considering factors like inflation, operational changes, and potential cost savings. Projecting cash flow accurately considering both inflows and outflows, and planning for potential liquidity issues. Evaluating expected profitability, taking into account market conditions and operational efficiency. Risk management and reality. Risk management is an integral part of reality, checking in corporate finance. Market risk assessments. Analyzing how changes in market conditions could impact the company's financial performance. Assessing the risk of default by debtors and making provisions for bad debts. Identifying risks in operational processes and devising strategies to mitigate them. Strategic risk evaluating. Evaluating risks associated with strategic decisions such as entering new markets or launching new products. Reality checking in investment decisions. Making investment decisions requires a realistic assessment of potential returns. Analyzing potential investment projects for feasibility. Expected returns and alignment with the company's strategic goals. Conducting a thorough cost-benefit analysis to weigh the potential gains against the costs and risks. Calculating ROI realistically, considering all potential variables and market conditions. Communicating reality checks. The financial manager must effectively communicate the outcomes of reality checks to stakeholders, providing realistic financial insights to the management team to aid in informed decision-making. Investor relation, communicating with investors about the realistic prospects and risks of the company's financial performance. Employee communication, ensuring employees understand the financial realities of the company, especially when it impacts operations or compensation. Conclusion, the role of the financial manager as a reality checker is crucial in ensuring that the company's financial strategies and decisions are viable and sustainable. This involves a thorough understanding of market dynamics, internal capabilities, risk factors, and realistic financial projections. By performing this role effectively, the financial manager helps to steer the company towards financial stability and long-term success. Risk management in modern finance is an essential function, integral to the strategic planning and long-term sustainability of a business. The financial manager's role encompasses in corporate finance. Negotiation is an indispensable skill for a financial manager. It involves dealing with various stakeholders, including investors, creditors, suppliers, customers, and employees, to reach mutually beneficial agreements. Key areas of negotiation: capital raising, negotiating terms with investors or creditors when raising capital, whether through equity or debt, handling negotiations in RA activities, including deal structuring, pricing, and terms. Conversing supplier agreements, negotiating terms with suppliers and vendors to optimize costs and payment, structuring compensation packages and incentive schemes, especially for top management and key personnel. Principles of effective negotiation, preparation and research, understanding the needs, strengths, and weaknesses of the other party, setting clear objectives, knowing what the organization wants to achieve. The Susan frame. Here. Concise and assertive communication is vital. Is in creativity, being open to different solutions that can satisfy both parties. Maintaining professional ethics and integrity. Building trust and long-term relationships. For negotiation and capital raising. Equity financing. Involves negotiating with potential investors, venture capitalists, angel investors, or the public on the valuation of the company and the terms of equity offered. Debt financing, negotiating loan terms with banks or terms of bond issues, including interest rates, maturity, covenants, and collateral requirements. Association in mergers and acquisitions. Deal structuring, negotiating the form of payment cash, stock or combination, deal structure, merger, acquisition, takeover, and post-merger integration plans. Determining the purchase price based on valuation methodologies. Synergies expected and strategic importance. Due diligence and legalities. Negotiating terms during due diligence, including warranties, indemnities, and dispute resolution mechanisms. Vendor and supplier negotiations, negotiating for better pricing, bulk discounts, or favorable payment terms. Long-term contracts, establishing long-term contracts for supply chain stability. Quality and delivery terms. Ensuring quality standards and reliable delivery schedules. Employee compensation negotiations. Negotiating compensation packages that are competitive yet sustainable for the company. Equity compensations, offering stock options or equity participation as part of compensation, especially for senior management. Structuring performance-based bonuses, or incentives aligned with company goals. Skills and strategies in financial negotiation. Analytical skills, ability to analyze financial data, market conditions, and legal documents. Strategic thinking, understanding the long-term implications of negotiation decisions. Managing emotions and understanding the emotional dynamics of the negotiation process. Conflict resolution, ability to handle conflicts and find common ground. Ethical considerations. Being transparent about the company's financial position. Ensuring the terms negotiated are fair and reasonable for all parties involved. Regulatory compliance. Adhering to legal and regulatory requirements in all negotiation processes. Conclusion. Negotiation in corporate finance is multifaceted, involving a range of activities from capital raising to employee compensation. The financial manager must employ a mix of skills, including preparation, communication, analytical ability, and ethical considerations to navigate these negotiations effectively. The outcomes of these negotiations can significantly impact the company's financial health and strategic direction. In the dynamic landscape of corporate finance, the financial manager